think like an owner. You're never going to care unless you put your own money at stake alongside that of your partners. And I've done that since our fund won. And at this point now, I've got more than $15 million of my own money. So I'm thinking about this like an investor, and our investors appreciate that.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And today's guest is Matthew Ricciardella. He's the founder and CEO of Crystal View Capital, where he oversees $500 million portfolio of mobile home communities and self-storage assets. With over $1 billion in real estate transactions under his belt, he's built a vertically integrated firm that thrives in undervalued markets. So what's especially unique is Matthew and his team don't just buy right. They've built in-house systems to fill vacant lots, finance homes, and manage every inch of the operation. And we're excited to jump into it today. Matthew, thanks for joining us. How are you?
I'm doing great. Neil, Clint, thanks for having me on this morning. Appreciate it.
Absolutely. Yep. Excited to have you here. And Neil and I are self-storage guys. So we're excited to hear about what you're doing there, but especially what you guys are doing in the affordable housing side of things, which is obviously a big need. It's not going away for a very long time. Besides what we know about you, why don't you tell our listeners a little bit about yourself, about your background, and everything that you got going on with Crystal View Capital?
Yeah. So, look, it started for me in this industry about 20 years ago. I started off as a residential realtor, and I'll try to give you the abbreviated version of the story. But from New York originally, grew up in the Catskill Mountain region, and my family came from the restaurant business and started working in that business as a young kid. I was like 9 years old when I started washing dishes in one of my dad's restaurants. So learned the value of a dollar and hard work at a very young age. And for some reason, maybe I watched too many episodes of Baywatch or something, always wanted to move to Southern California as a teenager. So applied to all these different universities. The only one that accepted me was Cal State Long Beach. Wasn't the best student, so ended up going there for a short period of time, dropped out, and got in the real estate business. I was a residential realtor, and the way I built my business up was cold calling. I didn't really have any connections or know anybody in that area, so the most logical way to do that was picking up the phone and knocking on people's doors. So built up a pretty nice business as a young kid, 2021, doing that, and then wanted to be an investor. So I started flipping homes, and the way I did it was the same way that I built my my real estate business up as a realtor, which I called people on the phone directly, asked them if they wanted to sell their rental property or their home, and I would buy those homes and put a little bit into them in terms of rehab and turn around and sell them. And probably in about 06, 07, really wanted passive income, wanted mailbox money. So gravitated away from flips over to commercial real estate. And I invested in retail, industrial, office, multifamily, and did well, found these deals off market, picked up the phone, built relationships. That's how I bought for pretty much my entire career. And what I did was I gravitated to manufactured housing communities and self-storage because there was some key dynamics about those asset classes that attracted me and which were intriguing to me. One was very inefficiently priced. So you had mom and pop ownership. You weren't buying from Blackstone by any means. You were buying very inefficiently run and operated assets, which could be purchased at very fair valuations or below market valuations. So that's kind of what that's what really grabbed my attention and why I focused on these two asset classes. So, kind of built up a book of business and was a investor just for my own account. Didn't really raise any outside capital. Had a nice cash flow in both mobile home parks and storage, and built some efficiencies around operating these assets, and thought to myself, hey, I'm on to something. I'd like to scale this business. So started raising outside capital. And that's why I formed Crystal View Capital, and that was back in 2014. And it's been a heck of a run, and here we are today.
Now, Matthew, you've been in self-storage and manufactured housing, mobile home parks since what year did you start investing in it?
2007.
Okay. So you've watched a pretty major transition for those two asset classes. How has that changed over the last, now almost 18 years?
Well, there's been a lot of twists and turns, right? When I started in these two property types, they were both kind of like redheaded stepchilds, right? When you were at a cocktail party back in '07, when everybody was buying retail and industrial, and you said, "Hey, I buy trailer parks and self-storage," just kind of got a funny look, right? Like, why in the world would you do that? Well, I had my reasons, and I had conviction in the asset classes, and the only regret I have is not buying more and selling. Those are my two regrets from being in these two asset classes. But looking at where we are today, you've got a ton of interest from institutional capital that's flooded into both asset classes. So look at office as an example that is just dying. And I don't think that trend of office occupancies falling is going to abate anytime soon. So when you think about commercial real estate, those large pension funds and institutional capital, they're not going to leave commercial real estate. They're going to look for an asset class that's got safe, predictable cash flow streams. So they're going to come into more of these niche investments like they already have in self-storage and manufactured housing and what we do. And I think they're going to do even more allocations in those asset classes in the future. So that's the big difference between where we were back then and where we are today. And the big driver to that is the liquidity and the ease to finance these assets. You've got Fannie and Freddie on the manufactured housing side, which you didn't have back then. You were kind of relegated to seller financing. And then on storage, you got the CMBS markets that have pretty attractive financing. So, that's been the big change from '07 to 2025.
I love how a lot of times we talk to people that have come across a similar journey of investing into single family homes. Residential real estate is the 800-pound gorilla in the room when people talk about their background of where they got started. And then people that have vision can move on through that and grow and scale. But it's funny how so many of the fundamentals remain the same, right? Especially when it comes to forced appreciation, natural or forced appreciation through swinging a hammer or conversion of asset class, whatever it may be. What really matters is buying it right. Right? If you're flipping a house, you don't make your money when you sell it. You don't make your money when you renovated it. You made your money when it smelled like dogs and cats, and you picked up the phone and you made the cold call and you built the relationship and you bought it correctly. So those fundamentals a lot of times don't change if you're flipping a single family house or buying a BRRRR rental or buying a storage facility or anything else. So in terms of buying it right and creating the value, what does that look like on one of your deals and what you guys are bringing to the table for your investors?
Yeah, great question. And you are right. It is fundamental, and I don't think it hasn't changed looking back from when I started, and I don't think it's going to change 20 years from now. We are in an industry where it is based off relationships, right? And people do business that they have a relationship with, and that's what we strive to do here at Crystal View. We've built an in-house sales team. Back to that vertical integration, guys. We're not really competing in auction processes and best and final offers with brokers. What we're doing is we're going directly to the source. So we are picking up the phone, we're getting on a plane, we're having dinners and lunches with mom and pop owner operators of these assets. And we're basically situating and positioning ourselves as the best suitor for the asset, both in terms of we've got liquidity. Our capital raise has been quite strong in Fund 4. And number two, I think there's an emotional connection for these folks. It's more than who could strike the largest check. It's more or less who's going to be the best steward for the asset. Sometimes their grandparents built it and they want it to go to somebody who is going to uphold that tradition, invest back into the community or the storage facility, someone who is going to make them proud. So that's what we spend our time, focus, and energy on, and it's proved out well. We've bought, again, over $1 billion of assets throughout my career following that approach, and based off relationships, I don't think it's going to change anytime in the future. So in my mind, it's the best way to acquire deals. It's hard work, to go out there and to aggregate and roll up these onesie twosies all throughout the country takes a tremendous amount of energy and hard work. And most people just want to be capital allocators and don't want to put in that work. And that's how we create alpha for our investors. We're willing to put in the work.
Yeah, it's a tremendous amount of work if you want to get that handshake deal or sit down and break bread together. It's something that's not easy, especially it is becoming so much easier to lean into technology and AI and go that route. But I would actually say that as that continues to grow, I think the value of in-person communication and relationships is actually going to be more valuable than it ever has been. People are going to have more noise in the space of more people reaching out to them because they have access by leveraging technology. That as above a certain point, that just becomes baseline noise in the background that's easy to ignore, like a mailer that you get in the mail. Like everybody remembers the first time you get some new approach, it's like, oh wow, somebody wants to talk to us about buying a property we have for sale. Okay, get 200 of those in the mail and tell me how much weight they carry with you, right? And as that cheapens, I see the value of personal relationships and being willing to take those steps go up. So I think that's super important. And that focuses on the buying right side of things, building the relationships where you recognize that this is a fragmented market and the mom and pop operators likely have poured 20 years into this property. Their grandkids used to run around while they were weed eating sometimes. So it becomes a personal connection to the property and they want to see it go to the right person. Obviously, you have to afford it and everything else, but I love that the recognition of the perspective of your sellers. So that's super cool. One of the things that you guys do that is a little bit unique is that there's a lot of people out there buying mobile home parks and affordability for housing is a real issue. But the way that you force appreciation right now, the prices seem to be a little bit up. So you're going in and some people will try to sell the mobile homes back to the tenants so that you're just owning the dirt and they're in control of the maintenance and you're really getting that off of your books so that they're handling the capital expenditures. And then you're trying to increase the lot rent and increase your net operating income. And then you may buy a mobile home park with 50 spots and 7 or 8 of them are empty and you got to navigate that. You guys kind of have a specialty in that. And like you have an in-house team to source and set up homes on vacant lots. So I want to walk through that around that operational side of things because I've never heard anybody like have an ingrained vertically integrated in-house strategy of how we're going to fill the void on this rent roll here. And these are the spots that we have empty. So tell me about that.
Yeah, I'd be happy to. I think it comes back to the culture at the end of the day. And we try to instill a mantra in our culture of think like an owner. And back to what I said earlier, a lot of my peers and competitors, they're pure capital allocators. So what they're doing is they're good at raising capital. They want exposure to the asset classes. Once they buy them, they're typically looking for a third-party property management company to create value on their behalf and on their investors' behalf. And in my mind, that's kind of like hoping and praying. Nothing wrong with that, but that, in my mind, isn't a good business strategy. In my mind, it's about controlling our own destiny. And the way we do that is we've developed, to your point, an in-house sales team. So we call it a home sales coordination team. And what that team is doing is it's looking at all of our parks throughout our portfolio and saying, where does demand lie in this marketplace for folks that want to buy a home? Where that demand is strong, we find out also through technology, because we're vertically integrated. We have our own call center and we track all of that data and understand where that demand lies. We buy 2 bedrooms, 3 bedrooms, double wide, single wides based on the market and that demand within that individual market. So we buy those homes, we place them on the sites. We have our own in-house marketing team. That marketing team is placing ads. Those incoming calls are coming into our call center. We have salespeople that are trained to convert those leads into sales. And that's how we've really been able to grow our occupancy at a pace within our mobile home communities that we have not been able to do in the past. So it's really been remarkable. And I think it's the same approach on storage. There's some nuances between the asset class. But again, we control that process from A to Z on how we market that property, on how we convert incoming calls into rentals at our storage facility. And that's all done in-house. And we've built proprietary technology to do that, and systems and procedures. And we have a fantastic team that's overseeing and executing that. Once again, it's not that complicated, but it requires a lot of hard work. And that's kind of been our niche and our secret sauce to all of this. We're willing to do the work, not only on acquiring the asset, but creating value and managing it effectively.
Got it. A quick follow-up question for clarity. When the units that you're putting in, are you buying those new or used? And if you're buying them new, are you guys a distributor to get a better cost on that? And then are you selling those to the consumer at the end, or are you just leasing?
A little bit of all of the above. So first, to answer the first part of your question, we buy pre-owned, but mostly we buy new homes. And we are dealers in all of the states that we operate in. So we are buying them at wholesale from the manufacturer. And due to the size and scale of our organization, we'll go to them and buy 10, 15 homes at a clip, whereas somebody else is going to only be buying one. So we're going to get some pricing concessions from that manufacturer. Then we're going to set those up on the site. We're going to put that marketing team in place. Most of them, we look to sell them. So we've got some relationships with finance organizations that are out there that finance these homes within these parks, which is really a niche type of lender. You can't really walk into Bank of America and ask for a chattel loan on a mobile home within a community where you don't own the real estate. So we know who those lenders are in those regions. We have relationships with them. We help pair the buyer up with those lenders to get them the most attractive financing. And we sell the home. We give them a piece of the American dream and take those sales proceeds and rinse and repeat and do it again and again.
So I've heard you previously talk about passing utility costs through to residents by submetering the units. How do you balance that with maintaining goodwill in the community?
Yeah, so it's not submetering units, just for clarification, submetering utilities. So what we're doing is, let's say we buy a community that has a master meter for water and sewer. The way, again, our team has a keen focus on creating value for our investors across our portfolio. So what we're going to do in that instance is we're going to install sub-meters on all of the units within that community. We're going to pass that expense through, Neil, and that's all going to fall to the bottom line. That's going to grow NOI and create, obviously, more that property value is going to increase, and that cash flow is going to rise as a result of that action that we've taken. And the way we create goodwill there is, come back to the culture again. What we try to do is build a relationship with those residents. So I see a lot of our peers and competitors that really don't have an on-site presence, and I think that's a mistake. Where you walk into a community, you start sending out rent increases, you start passing through utilities, and you're not investing back in the community, and you're not showing the residents that you care and hearing them out. In this industry, rents are rising. I mean, there's no two ways about it. And we share with our residents when we increase rents, what's going on in the market and why we raised rents where we did. And if we could show them that we're still less than some inferior communities in town, they're going to have a hard time saying, hey, you guys are evil and bad, because we're showing them where rents are and we're investing back into these communities. A lot of times we're putting in new roads, clubhouses, buying brand new homes, as we discussed. That's all increasing the curb appeal. That's increasing the value of their home. Well, they may not be, we may not be their best friend at that point in time where they get that rate increase, or we're passing through the utilities. Over time, that on-site manager does a good job explaining this and being there with them. And that's what really mitigates those concerns and builds goodwill while creating value at the same time.
I love that. Doing the work to educate that if you're all in the same boat together, you're all rowing in the same direction, and helping them recognize that, yeah, they feel money going out, but if they see it as they're building equity on their end as well, I think that makes a lot of sense.
Yeah, it's mutual. That's
Yeah,
right.
it's a really unique approach. I love that. It's putting people first, which I love that. Let me ask you this. I know you said one of your regrets is anything that you've ever sold. You're clearly a long-term hold guy. You're talking about adding significant value to these properties versus pulling the levers that you can control. I want to shift a little bit and talk about what that looks like for your investors. And also, I know that you've put 15 million of your own dollars into your funds and your operation. So I'm happy to loop that in on the conversation at some point and see how using your own money may have shaped what your thesis is and your strategy. But from the investor standpoint, I want to know, what does the return profile look like and how long does your average deal last? I'm assuming if you're not selling, I know you're going to sell some stuff and probably trim the portfolio, but you're probably doing either refinance or cash out refinance, or else it's all coming by cash flow. So from that side of things, who's the avatar of who your investor is, and what is your thesis or long-term hold strategy so that we can identify who might be the right fit for what you're doing?
Yeah. So back to the thesis that I've had from the outset is think like an owner. You're never going to care unless you put your own money at stake alongside that of your partners. And I've done that since our fund one. And to your point, at this point now, I've got more than $15 million of my own money. So I'm thinking about this like an investor, and our investors appreciate that. And I'm not the only one. There's other team members here that have invested in the LP, and it's on the same terms as our LPs. We don't get any preferential treatment. But to answer your question of the avatar around who our investors are, typically retail investors, some smaller family offices. A lot of these folks are people that have had liquidity events, who have had success in their own business, that want passive income, that love the positive attributes of real estate, which you get depreciation, you get appreciation, you get cash flow, but they don't want the day-to-day hassles and headaches of managing these assets and putting all these systems in place that we've been successful in putting in place, which is a full-time job. They want to just reap the benefits of that value creation, which obviously there's nothing wrong with it. They've done quite well. But that's the avatar. And to answer your question about return profiles, our fund one had a 47% gross IRR. Our fund two, we're tracking to the high 20s, low 30s. And fund three, we're tracking in the high teens and low 20s. And our fund four, which we just launched last year, we're already hitting a 9.2% cash on cash return. And we're projecting a 20% IRR over that vehicle. That's a $200 million equity raise. We feel those are quite conservative assumptions. But to answer your question, you also asked, how long do we hold these investments, and where have my regrets stemmed from? Typically, we underwrite these deals as let's call it a 5 to 7 year hold. We're set up in a private equity structure, so you do have to sell. You can't hold these indefinitely. Some of them I wish I could, and some of them that I have sold in the past, I look back and kick myself. And I'll give you an example. We had a deal in our fund two, which was a large mobile home community in Kentucky. I think it was 330 sites, and we bought it for 7. We sold it 8 months later for 15, and I thought, man, this is one of the best deals I've ever done. I can't believe we got this much. But now I look back and go, why did I sell? Because that community is probably worth 25. So, you live, you learn. That's how life goes. You can't keep these things forever. And based off the structure, eventually we have to sell. But hopefully that's answered some of your questions.
There's a lot of new operators who've entered this space in the probably last 10 years. It became very, like you said, early in the process, it was kind of a redheaded stepchild. But it got sexier over the last 10 years. It worked out and blossomed. So I've heard you mention that a lot of new operators underestimate how management intensive mobile home parks can be. What are some of the biggest traps you see these newcomers to the market fall into, and how do you guys avoid them?
Traps in terms of operations, you're saying?
Yeah. Management.
It's one of those things where it's pattern recognition. I think is what I could sum it up to. When you've been doing this for as long as I have and some of the team members on our team have, you could pick up, and it helps you become a better investor when you're a good operator. I think they're going to run hand in hand. So when you're underwriting a deal and you're a best-in-class operator, you're going to see the issues there. Are there park-owned home income kind of built into the NOI where it shouldn't be? On the storage side, are you in a weak market where, that broker is telling you you're going to lease up to this amount of occupancy? But when you do a deep dive in the marketplace, if you know how to do that deep dive, and if you have analytics by owning nearby, which we do, we're in 31 states, by the way. And with that comes a lot of value because we've gathered all that data across all of our portfolios. So when we go out and acquire and we're near, we already have assets near the target, you're going to be able to very quickly size that deal up and say, hey, we're not going to be able to hit these assumptions, or we could exceed the assumptions that the broker or the seller is telling us, and we're going to move forward with that deal. But, the pitfalls, I think the big thing is it's trial and error, and a lot of it's scraping your knees. I think the advantage for our investors are I've scraped my knees over almost the last 2 decades. I'm not going to look people in the eye and say I'll never make a mistake again, but I've made a lot of them, learned from them, and built systems around avoiding those mistakes in the future. And I think someone coming into this industry today doesn't know about all those mistakes they're about to make. And as a result of that, I think their return profiles probably won't be what ours are.
I totally agree. And it's not that forgiving when you're using other people's money. So I certainly understand the value of that. I really love, so much data is available these days, and a lot of people are using it, and a lot of people are using the same data to look at deals. I really, and this is coming from my perspective of owning a property management company, I really value having a large enough portfolio that you can become your own data set in a market, and you have access to proprietary data that's on the inside of the vertically integrated system that you built, and not you're just paying for third-party data that's performance data that's been reported. When you have assets in the area, when you have management in the area, when you control those fixed overhead costs, I think that is a superpower, right? That's a secret weapon that you've got a secondary data source to tap into that is right because you've built that source yourself. So I think that carries a lot of value.
Yeah, that's right. I mean, it allows you to scale. It's very synergistic where you could have managers already in place in that market help in managing the new asset that you're bringing into the portfolio. So you've got cost savings there. But to your point on that, Clint, we've aggregated data over the last, 16 to 18 years in a lot of these different markets. Even if we've sold an asset, we'll go back, look at our performance from when we owned it, compare it to what's going on today in the future, looking at job growth. There's just a lot of information and data that we have that's proprietary that most buyers aren't going to have, and we can make better investment decisions because we have that data versus if we were going out buying it from some third party, which could be tainted, and I don't know how much I would trust.
I love that. All right. Well, listen, Matthew Ricciardella, founder, CEO of Crystal View Capital. Thank you for coming on with us today, sharing about your pedigree, the success that you've had, the long-term track record, the ability for other people to invest with you and learn from your mistakes instead of making their own. Thank you for your time today and for the education. If people want to learn more about what you guys are doing at Crystal View Capital or find the best way to communicate with you, what would be the easiest way for them to connect?
Yeah. So you could visit our website at www.crystalviewcapital.com or reach out to us at invest@crystalviewcapital.com. We'd be happy to answer any of your questions.
That's awesome. Well, thank you, Matthew. We really appreciate your time.
Thanks, guys, for having me. Appreciate it.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode, leave a comment down below, or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.